The trend is your friend until it ends. But eventually, every trend has to come to an end. The market will reverse at some point, and if you are buying in an uptrend and it flips on you, you're going to take a loss. But what if we could see when these reversals were likely to take place, so that rather than taking losses, we could take advantage of the new direction of the market and actually profit from reversals? Well, that's what I'm going to show you in this video. I'm going to teach you how to identify reversals, how to confirm reversals so you lose less and win more, and how to take advantage of the new direction that the market makes. And let's not waste any time, let's get straight to the learning. So when we have a clear trend in a market, it's great. We can just continually buy each low if the market is in an uptrend, and we can look to profit from the movement up. But eventually, we may go for a buy, and then the market will flip on us. This trend is not going to last forever, and the market will eventually reverse, which means if you are buying in this uptrend, eventually you're going to lose. Now, there is actually a way that we can identify when the market is reversing. But we can't just guess at when the reversal is going to take place. We can't just sell every high in the market because it can just continue moving higher. One of the worst things people do is what we call catch a falling knife, where they think, okay, the market's been going up or down for so long that it has to reverse now. So I'll buy right now or I'll sell because it has to turn around. It's been going down or up for too long. The market can stay irrational longer than you can stay solvent, meaning the market can do whatever the market wants to do. Even if it seems like it logically has to turn around, that doesn't mean it will. So we cannot catch falling knives, we cannot sell tops randomly, we cannot buy lows, we have to confirm reversals. And I'll show you how to do that right now. The absolute first thing we need when looking for reversals is context. We need to see a reason for the market to reverse. So if we take a look at the current downtrend that's happening in this market, how would we know when this is going to turn around? Well, some amateur traders would look and think it's been going down for so long, it has to go back up, so I'll buy it now. This is obviously a terrible idea because we don't know when this market is going to reverse. You are blindly guessing, and that's not going to be a good way to trade long term, even if it pays you off once or twice. So to get context, what we want to do is look to the left. If we take a look at some of the older price action and the previous movements formed in the market, we can build context behind where reversals might take place. Now, the two ways that I like to look for context are going to be through supply and demand and key levels. So supply and demand refers to supply and demand zones. A demand zone is a consolidation area before a large up move. We then use this consolidation, and when the market pulls back to this level, we buy once again. And a supply zone is the opposite. It's consolidation before a down move. When the market pulls back, that becomes a high probability selling point. I've got a full video on supply and demand. If you don't understand the concepts at all, there's a card somewhere in the corner of the video now. The second thing is key levels. So key levels are basically horizontal lines that we draw on the chart, and they would be situated at the 000, the 250, the 500, and the 750 levels. Now, these are basically seen as institutional price levels that larger players take profits at or get into positions at. It's nice rounded off numbers. We see reversals take place around these levels. So by looking at this chart with the new concepts of supply and demand and key levels, we can see that just down here, there's a demand zone. So there's a consolidation before a large up move. Now this consolidation candle with the wicks either side is going to be what we use as our demand. So we can mark that candle from the high to the low, and this becomes our demand range. When the market pulls into this region, that would be a high probability area to start seeing a reversal here. We can see that within that we have the 1.21 key level, so the 000 key level. That's a very rounded off number. This is another point of which market reversals take place. So now we've got two reasons for reversal. We've got the key level, we've got the demand. And we can see above that, we don't really have anything. Now you might be asking, isn't this a demand zone here, this consolidation before the large up move? Yes, it is, but the market has come back and retested it already, as you can see. Once the demand zone has been retested, it is no longer of use to us. This one has not been, so this is still in focus. With this new context, we can see that basically between that demand in this region here, there is no reason for reversal. There's no demand zones, there's no core key levels lining up with any demand zones. There's pretty much no reason for us to reverse until we reach this demand. So this range here is pretty much an open range that we could trade through. Now, when we do get towards that 1.21 and that demand zone, this is where reversals are highly likely to take place. Okay, we've got a high probability region with a high probability key level. This is where the reversal would take place from. So rather than going for the opportunity to catch a falling knife and buying here simply because the market is moving down, you've now got two opportunities. First of all, you can actually find opportunity in the selling movement. So you can look for trades on lower timeframes to sell down through this open range because we know there's no reason to reverse in here. And then second of all, when we reach this area, we can start looking for those reversals so that we can profit from the reversal back to the upside. Okay, and I'll show you how to do that in just 1 minute. But let's take a look at how the market plays out. You will see we come down comfortably, trading into this area. So that is step number one, context. Once we have context behind why a reversal might take place, that provides us with the first thing we need to see. We now have a high probability area. We are not so much just buying for the sake of buying or catching a falling knife. But there's something else we need to talk about because, okay, the market could reverse from this point. But then we could say it could also reverse from this point down here. Why would it not do that? That's entirely true, and that can happen. Which means if you buy into the market here, you can still lose because maybe the market wants to reverse from a lower point instead. Or maybe it just wants to continue selling for the longer term. So in order to avoid piling on buys at every single area that the market could reverse from, we can now introduce a concept that I call the standard confirmation. To identify which way the market is going, we want to view the price structure highs and lows. So a market that's continually forming higher highs and higher lows, like this one here, is in an uptrend, and we should only look to buy. A market that is forming lower lows and lower highs is in a downtrend, and we should only be looking to sell through this trend. Now, to avoid catching a falling knife, we never want to buy in a downtrend. We never want to sell in an uptrend. We need to make sure that the market is in agreement with us before we start taking buys or sells. So as discussed, a market that's forming higher highs and higher lows like this is an uptrending market. But what we can actually do is plot these higher lows, and once the market breaks one of these higher lows, that would actually drive us into a lower low, okay? So like this. Now, what do we know from that downtrending example we just showed? When we see lower lows, we expect that to be followed by new lower highs, and then new lower lows, and the market shifts into a downtrend. So this entire piece of price action, just here, is what I call that standard confirmation. It's a very repeatable pattern. We're going to see it a lot of times in the market. And what it is that we're looking for is simply a shift from an uptrend into a downtrend by identifying that break of structure at the reversal point where the higher lows shift into lower lows. And then we are looking to sell the lower high just here. So what we're seeing now is a full-on reversal and the structure agrees with us, which is why we want to see this before we get into trades. Now the same is exactly true for a downtrend. When a downtrend starts breaking from lower lows and lower highs into a higher high, then we can use that next leg of structure to try and buy a higher low. So by bringing this structural confirmation in, we're no longer just relying on the context from the higher time frame zones, but we can actually use the structure that we see on the lower time frames inside of those points of interest to get the highest probability reversals. So now let's go back to the example we were looking at before, and I'll show you how to put this into action. All right, so we're back to this example. As you can see, we've got our context, we've got demand, we've got a key level. This is where a reversal is likely to take place, if anywhere. So to bring in the standard confirmation and make this trade incredibly safe and high probability, what we want to see is basically this pattern taking place out of this zone. And if we see the structural shift here to higher highs, we will use the higher low here as our buy point. That's where we want to buy from, okay? Now, generally, when we're enacting this standard confirmation, we're going to go to a slightly lower time frame because we want to see a more scaled in view of the price action. So for this example, I would go down from the daily to the 4-hour. And by the way, guys, this works on absolutely any time frame. It doesn't have to be the daily and 4-hour. It could be the 10-minute and 1-minute if you wanted it to be. So now on the 4-hour time frame, what do we want to see? Well, we want to see the market retest this 1.21 key level. And we also want to see some structural shifts taking place in the market like this, where we will then look to buy this low. So let's allow this market to play forward and see if we get a retest of that key level. So as you can see, we've now came into that key level area. We've started to see a little reversal down here, but it wouldn't be safe to buy just here. Now, you can make a career out of buying inside of zones without using this confirmation, but your win rates will be low, and I want to teach you guys to be accurate traders. So what can we see in this market then? We've got a lower low, lower high. We've got a lower low, lower high, lower low, lower high, lower low, lower high, lower low, okay? So from a structural point of view, this is going to be the point that we want to see broken. This is the lower high that would change the trend. So if the market is now able to push up, we would then identify a demand zone to buy from, place our orders, and then see how the market plays out. So here we have a little formation. We haven't broken structure just yet. There's the break. That's what we want to see. Now we want to identify demand. Okay. So for me, I would use this candle down here. I would cover the entire wick, but basically we're looking to use this consolidation before the large up move. And I always want to use the last candle before the impulse. Now for me, the last candle before the impulse in this instance is going to be this small candle here, but I always want to clear the lows. So I'm going to actually use this larger range from the high of that candle down to the very low of this wick. So now that we've had that standard confirmation, we've had the break of structure, we have this demand zone open, what we would do is place our orders here. So we'd place our order on the demand zone. Our stop loss is going to go beneath the low, and then our targets are going to go upwards to, well, wherever we want it to target. So for this example, let's actually take the market all the way back up to these highs in the trend here. We're seeing if we can get a full-blown reversal in the market here, so we might as well be ambitious with our targets. Now, all we would need to do is allow the market to play out with our orders placed. So that would be a buy limit. Providing the market taps us in, we should then be on for a profitable move because we have the trade confirmed. So there we go. We got our retest of the demand zone at this point just here. Now we will see how the market plays out. As you can see from the daily perspective, we've now shifted entirely into a new trend. Okay. So on our way through towards the targets, you can see the market is now forming higher highs and higher lows consecutively. So rather than forming lower low, lower high price action like we were previously, we got that structural shift and the market has completely changed direction into an uptrend. Now this uptrend in itself would provide new opportunities for you to buy throughout upon the formation of each new low, but catching the reversal gives you the biggest trade. It's going to give you the highest risk reward and the largest amount of pips that you can actually profit from because you're catching the movement at the very bottom. But you're not gambling into it. You're actually waiting for the structural shift to agree with you to tell you the trend is now bullish. That's exactly what we did, and the market has played through into our analysis very, very nicely. So there you go, a solid example where the market shifted from lows into highs and provided us with a safe, confirmed reversal that we could trade out of. Now, leading this into a live example, as of right now, if we were looking at this market, where would be the point where we would expect a reversal to take place next? So obviously at the moment, the market is bullish. It's just trending up. There's no real reason for us to reverse. If we were going to look for a reversal, where would it be from? Well, it would be from this supply zone at the top of the trending move. Why is that? Because there is no other supply zone that hasn't yet been retested. So the market can easily creep up towards this point and then provide reversal opportunity from there. So now you can see there was some trickier price action, some trends inside of the larger trend that we could have taken advantage of on the lower time frames. But now that we've met this supply, I want to show you the 4-hour time frame as to where we are right now. If you take a look at how the market is moving right now, we can see the market structure has shifted up here. We've gone into higher high, higher low, higher high, and then the market came down and broke that structural low, putting us now into what could be the start of a downtrend. So something I want you to follow in the future, because we can't put it in this video because this is real time, is what does the market do next? I'd be looking at this kind of region here for a reversal in price, with also the potential that the market could get up to this point and then reverse. So just a little live one for you. Keep an eye on this market and see what happens in terms of reversals from this point here or this point here. Don't guess your way into trades and get caught catching falling knives. Make sure every trade you're looking for has context. And if we've got good context, then make sure you wait for that confirmation so you can have the highest probability, highest odds of success. And now the best video to watch next is this one, which elaborates more on market structure. So go and check that out. Alternatively, there's a free course in the description. I hope you enjoyed the video. Thanks for watching. I'll see you in the next one.